Hey everybody, Anthony Fletcher. Thanks for showing up at my channel today. We're going to real quickly go over who owns your mortgage and also what is loan servicing. Because a lot of people want to know what are the different avenues where companies get their money. And that's what we're going to talk about, who owns the mortgages. The first one is usually it will come from either credit union, small bank, or maybe even a private lender. And these guys generally what they do is they'll give you the money loan by loan. So in other words, for example, if you're buying a loan and you've got a harder type of program, maybe you're looking at a small property in the middle of nowhere, but there's something unique to it and they want to lend on it, they might give you the loan. And then what will happen is that you'll make your payments on a monthly basis to a loan servicing. These guys will actually hold the note on your mortgage. So if you ask them who owns my mortgage, the money actually, the files actually ends up with these companies out there. Now the loan servicer is a company these guys hire in order for you to make the payments, and then what they do is they send the monthly bill to you each and every month. And then what they do is then they pay the actual company. Now the second type of lender out there is what they call a mortgage bank, okay? And a mortgage bank, and this might be considered like a company, let's say like Stearns Lending used to be one, Caliber, Loan Depot. And these guys don't have their own money. They're called a mortgage bank, but they really aren't a bank, for example. What they really are is they borrow money from a company, and then they do their loans, and then what they do is then they pay the company back when they need to pay the company back. So this company, this money source that you would talk about, this might be a huge company, let's say like BlackRock Financial, which has trillions of dollars. And what they might do is they might agree to lend these guys $100 million in loans. And then what they'll do is they'll go do $100 million. Sorry, they'll give them $100 million. Then these guys will do $100 million in loans. And then what they'll do is they'll sell these loans to investors over here. And these investors might be like the Federal Home Loan Bank, they might be Morgan Stanley, Dean Witter, or they might be even an insurance company. And what they're trying to do is these guys have thousands of different investors down here, and they put money into their companies, and then these companies, and they're hoping to get a better rate, and they buy things like mutual funds and things like that. And those mutual funds, this $100 million is considered what they call mortgage bank securities. And what this company here will sell $100 million of loans to these investors out here, and these investors, and then what happens is, let's say it's the Federal Home Loan Bank, they'll turn around and they'll give the company, the Stearns or Caliber, whoever it is, they'll give them like $102 million, so they'll give them a premium, okay? And then they'll go out and do a bunch more loans, and then they'll pay them a premium again. It'll just keep the circle going on and on and on. So now how do these investors get paid for, they've given this company $100 million, just spent $102 million for all of these loans. How do they get paid? Well, normally there's a loan servicing company that is hired by one of these mortgage companies here, mortgage banks here, to do the servicing. So they take your payment, and then each month they pay the actual company out here that owns your loan. So sometimes these companies are big enough that they have their own loan servicing, but most times they don't, okay? Now the third type is your normal bank. So this might be like your Wells Fargo, for example. And what they do is they get money from two sources normally. The first one might be the Federal Reserve, okay? The Federal Reserve. And then the other way they get it is from the customer deposits. So the deposits from their own bank customers, checking, savings, things like that. And then what they'll go do and they'll go do the $100 million in loans again, okay? And then they'll also sell those loans then to those same investors, just like these guys did. And then they'll pay them money, and then they'll go out and do a circle and circle and circle again. The only main difference between these guys and these guys is this, is that they usually have their own loan servicing that's connected to the bank. And the reason why they do that is because by having the loan servicing there with them, then you're more likely to open up checking and savings and do investments accounts with these guys, so that it's a benefit to both you and them. Now, what's the drawback to going with one of these guys? Well, sometimes, they don't have as many products. These guys usually have a lot of products, but sometimes they can be higher in rate. And these guys over here are specialties normally. But there you go. There's how it all works. And thanks again for watching my video today. If you have any questions, please let me know. I sure appreciate your time. We'll see you again.